let's see. So when we select a mutual fund scheme, we look at quite a lot of things. One of those things is investor's risk profile, that is your risk profile and time available. And once we have all this information, your risk profile will depend on your income, age, occupation, financial goal, your current financial situation, and then how much time do you have available. So how we are going to use this information in selecting mutual funds. So once we have this, we can go ahead and start selecting mutual funds based on their different risk profiles, and uh, we'll create a portfolio which adheres to your risk profile as an investor. So what are the factors that will help us decide or choose a different type of mutual funds? So asset class is one of the major factors, and you already, it's very easy to understand. If you are investing in equity, equity is considered high risk. You can invest in gold, you can invest in debt securities, bank FDs, or corporate bonds. Then there is a type of fund. So type of fund will dwell all these pointers and details. Management style, objective of the fund, benchmark, which type of benchmark. If you don't have any other information about the fund, you can look at the benchmark they are following, and that will help you judge the risk profile of the fund. And I'll show you how that happens in a while. Performance analysis is what we look at the returns of long-term returns and everything. So, and finally, there are financial ratios, and there are quite a lot of them. So, we'll have a look at the most important financial ratios and how you can interpret them. You can find, you don't have to calculate most of these ratios. You will find the numbers already calculated if you search on the internet. Go to reliable sources, and you can look at these numbers. Even mutual funds information documents said, and they also provide these ratios, most of these ratios. So let's move on to the first one, and let's look at the asset classes. Or asset classes are pretty clear, so we'll get into that later. These are the types of different mutual funds. So there are open-ended mutual funds, there are closed-ended mutual funds. Open-ended means you can enter and exit the mutual fund at any point of time. There is no, so you will buy mutual fund units from the fund itself, and then you can sell the units back to the fund. You don't have to go to exchange to or some other investor to dispose of your units. Then there are actively and passively managed funds. Actively managed funds are those where fund manager is actively involved in selection, purchase, and selling decisions of the securities. Passively managed funds are those funds where portfolio once created remains pretty much the same till the end of the fund's life. These funds are, for an example, there is index fund. So an index fund follows the index portfolio. So if there are 30 securities in the index, those are the only 30 securities the index fund will also have. And as the index changes, the only when the index faces some change in securities, so some securities will go out of the index, some other securities will be added to the index. Only then the index fund will make any change to the portfolio. Otherwise, there is no change. So that's how index fund becomes a passively managed fund, because the fund manager doesn't have to actively make any investment decisions. The rest of the funds will be actively managed, and so in that sense, passively managed funds are a little less risky because there is a benchmark which is being followed, and that defines the risk of